Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Deep Source Holdings Limited annual report. Deep Source Holdings Limited offers a diverse range of businesses and services across various sectors. At the core of its operations are commodity trading activities, including the processing, distribution, and trading of bulk commodities such as petrochemicals products in China, Hong Kong, and Singapore. In addition to commodity trading, the company provides financial services that cater to both individuals and institutions. These include securities and derivatives financial services, margin financing, fund management, futures contract brokerage, clearing services, and financial derivatives consulting. The company also offers structured trade finance operation services, which facilitate complex financial transactions. Deep Source Holdings Limited extends its services beyond trading and finance by engaging in money lending business, brokerage of physical commodities, and trade facilitation services for gold and silver. Furthermore, the company provides loan financing activities, freight services agency business, and interdealer broking in over-the-counter markets. Deep Source Holdings Limited market capitalization of $12 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Deep Source Holdings Limited holds a significant advantage in their industry. Deep Source Holdings Limited trades at a higher price-to-earnings ratio of 16 times and a higher price-to-book ratio of 1.56 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 62% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets in equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth or decline can be identified through an analysis of various business segments. Revenue growth is primarily driven by the increase in iron ore sales, which saw a significant jump of 18%. Additionally, the company's associates, particularly Green Steel Limited, contributed to revenue growth due to increased profit sharing. The provision of services to ZHY Group and the purchase or sale of commodities with them also generated substantial revenue. On the other hand, revenue decline was observed in several areas. The sales of silver and gold ingots plummeted by 100%, while the distribution, trading, and processing business saw a significant decrease of approximately $19.5 billion. Furthermore, the sales from trading and processing of goods declined by 48.6%, although commission income and brokerage fees increased by 14.5%. It was not enough to offset the decline in sales. Interestingly, some revenue streams remained stable throughout the period. The provision of financial services maintained a steady level of approximately $147 million. This stability suggests that certain business segments are less susceptible to fluctuations in market conditions or other external factors. The company's financial performance is a testament to its ability to generate positive operating cash flow. According to the provided data, in 2025, the company generated an operating cash flow of $319,111, which is a significant improvement from the previous year. However, it's worth noting that the net cash generated from operating activities for 2025 was $563,193, which is higher than the operating cash flow. This discrepancy can be attributed to non-cash items such as depreciation and amortization, which are not included in the operating cash flow but are part of the net cash generated. Despite this, the overall trend suggests that the company is indeed generating positive operating cash flow, indicating a healthy financial position. The company's debt level and interest expenses have undergone significant changes. The debt level has increased substantially from $142,930,000 in 2024 to $546,583,000 in 2025, a staggering rise of over 383%. This increase is evident across multiple pages, including page 18 and page 179. Furthermore, the interest expenses have also seen a notable jump, rising by 39% from $20,310 in 2024 to $28,226 in 2025. These changes indicate a significant shift in the company's financial landscape, warranting closer examination of its debt management and interest expense strategies. Management is emphasizing several key aspects of the company's outlook and strategy. Firstly, they believe investing in associates is crucial for long-term growth and value creation. This suggests that the company is prioritizing human capital development as a means to drive future success. In addition, management acknowledges the impact of regulatory changes on the business, indicating that the company must adapt to these external pressures. On a more positive note, the company boasts a strong liquidity position, which will enable it to navigate any challenges ahead. The company is also committed to environmental, social, and governance (ESG) principles, recognizing their importance in enhancing value and providing long-term returns to stakeholders. Furthermore, management has implemented measures to prevent bribery and corruption, demonstrating a commitment to ethical business practices. Finally, the company will continue to engage in charitable activities and manage financial risks, including foreign currency exposure and price risk, to minimize potential adverse effects. Overall, these statements suggest that management is focused on creating long-term value through strategic investments, adaptability, and responsible business practices. The company has made significant moves through acquisitions and divestitures. In terms of acquisitions, the company has expanded its operations in distribution, trading, and processing by acquiring PRC. This strategic move is expected to enhance the company's capabilities and increase its market presence. On the other hand, the company has also engaged in divestitures as part of its business strategy. One notable example is the sale of its chemical trading business in Hong Kong and Singapore. Although this decision was made due to full impairment of the assets by 31 December 2025, it reflects the company's willingness to adapt and adjust its operations to optimize performance. The company's financial performance for the year ended 31 December 2025 reveals some key points regarding its capital distribution policies. Firstly, it is evident that the company has not paid any dividends to its shareholders during this period. This decision may be attributed to various factors, such as conserving cash reserves or prioritizing other business objectives. Regarding share buybacks, there is no information available in the annual report up to the specified date. This lack of disclosure suggests that the company did not engage in any significant share repurchase activities during the year. Concerns about inventory buildup and supply chain disruption are evident in the company's financial statements. On page 8, a significant decline in revenue is reported for various commodities, including iron ore, silver, and gold ingots. This suggests that there may be issues with demand or pricing. The inventory balance on page 100 highlights the importance of estimating future selling prices, which involves significant judgment and uncertainty. This implies that the company's ability to manage its inventory levels effectively is compromised by the unpredictability of market conditions. Furthermore, page 147 reveals a substantial decrease in revenue for the distribution segment, with a decline of 48.7% from $40 million, $21,747 to $20 million, $504,744. This significant drop in revenue raises concerns about the company's ability to distribute its products efficiently and effectively. Additionally, on page 167, an increase in raw materials inventory by 44% is reported, while finished goods inventory decreased by 3%. This discrepancy suggests that the company may be struggling to manage its supply chain, potentially leading to inventory buildup and associated costs. Lastly, page 182 shows a significant increase in trade payables to related parties controlled by a close family member of the ultimate controlling shareholder. While this may not directly relate to inventory buildup or supply chain disruption, it does raise concerns about potential conflicts of interest and management of company finances. That concludes the financial summary for Deep Source Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.